Did the S&P 500 really hit an all-time high? Or is it actually down 27%? I'm going to explain to you exactly how the economics work and why the S&P 500 is actually down in 2025. My name is Matthew Copley, President and CEO of Copley Financial Group, and I want to help you maximize your income and minimize your taxes. Matt, how can you possibly say that the S&P 500 is down 27% this year? It's at an all-time high. Well, actually, everything is at an all-time high if you price it in US dollars. If you look at stocks, all-time high. If you look at ground beef, all-time high. Coffee, all-time high. Insurance premiums, all-time high. Healthcare, all-time high. And I can go on and on and on. If you price all of these things in US dollars, yes, we are at an all-time high. But that's not how US dollars used to be priced. In fact, US dollars used to be backed by gold. If you go back over 100 years, gold was actually $20 for an ounce of gold. And then it went to $35 for an ounce of gold in the 1930s. But we didn't go off the gold standard until 1971. So when you look at the 1929 crash that happened in the stock market, that was a crash in the price of stocks versus gold, because the US dollar was gold. Today, the US dollar is not gold. We price gold separately. And the price of gold has gone from $35 to over $3,500 since 1971. And if you actually price the S&P 500 in gold, it's down 27% this year. So all of the numbers, all of the media, everyone will be talking about a 27% crash in the stock market this year if we were still priced in gold. And there's a website called pricedingold.com. You can go to that website and you can actually put in all kinds of different commodities and see what the prices are. And if you look at that website and see things priced in gold, it sure looks like we're already in a recession. In fact, I think we've been in a recession since the beginning of 2024. Maybe March, April of 2024, you see everything dropping off, whether it's priced in gold and copper. Dr. Copper, this is what they say the economy is, the strength of the economy is based on copper. Copper prices are collapsed since March of 2024. If you look at oil prices, energy, this is what keeps the economy moving, all the energy that we need. Oil's down 42% this year, priced in gold. Many people are concerned about a stock market crash. Has the market crashed already? It may be true that the market has already crashed. We talk about when is the market going to crash? Well, if you price it in gold, it's already way down. So the thought is what if, because of all of the inflation, that we're actually not going to see the market drop at all in US dollars? That is a real possibility. Now, there could be a short-term drop because of unemployment. When unemployment ticks up, you could see a big drop in unemployment, which would cause the nominal value in US dollars of all kinds of stuff, including gold, to go down. But how long would that really last? Not long. When you actually look at how we price all the things that we buy, it's very important for you to understand that we may not be in as bad of a financial position as many people think. In fact, one of the big concerns we have is all this debt. Oh my gosh, we're $37 trillion in debt. Well, first of all, 10 trillion of that is owned by government agencies. So really 27 trillion is the actual debt burden outside the US government. If you compare that to the economy, it's not that bad. People look at the debt that we owe and the interest that we have to pay on the debt. Well, the interest on the debt is 22% of the revenue that's coming in. That's a big number. In fact, that number is bigger than the national defense. We are spending more on our national interest on the debt than we are on our national defense. But is that 22% figure really that crazy? Well, in fact, it was actually much higher in the late 1980s and early 1990s. It actually hit 28%. And the reason is because interest rates were a lot higher back then than they are today. Now, if you actually look at what might come about because of the interest on the debt, the government most likely is going to do quantitative easing, and they're going to actually increase the money supply and continue to do what they're doing in order to drive that debt down. Now, one way they might do this, and I've heard some talk of this, there's rumors around Washington, D.C., that they are going to do a gold revaluation. What is a gold revaluation? This is actually taking a look at all the gold the U.S. government currently holds and actually valuing it at current real gold prices. Because right now they're still saying that all of that gold is only worth $35 an ounce on the balance sheet when it's 100 times higher. So if we look at the government's balance sheet, we have just over $10 billion in gold. The real number is over $1 trillion in gold, or 100 times that number. So one way the government could do quantitative easing without actually printing up the money and buying US treasuries is just to revalue the price of gold at current market prices. This would free up $1 trillion. This would be money that the government would not have to issue new treasuries. They could just simply add $1 trillion to the government's balance sheet. This is a real possibility. I see this potentially happening. This is one way that you get control of this. And if the current government shutdown, which just started, is any indication, there's a good chance that we're going to see the current administration cut a lot of spending within the government. And if we see a combination of a gold revaluation and the government cutting spending, our fiscal house does not look too bad at all. In fact, the US government is in a very strong position. Now, if you actually want to know what you need to do to make sure you protect yourself from this inevitable quantitative easing, whether it's the government printing up a bunch of money and buying treasury notes or just revaluing gold, you need to make sure your investments are hedged for the inevitable inflation. Now, the inflation that's coming is certainly going to take place within the gold market, so that is a good place to have money hiding in precious metals. That's why we have large positions in precious metals. We also want to invest in other things that go up even if we're in a recession. Things like agriculture, energy. People need to eat. They need to put gas in their car. So it's really important that you take a look at all of your investments and look for an opportunity to hedge against the inflation risk. And if you look at the returns on our tactical fund, which has all these inflation hedges in it, it's significantly higher than the S&P 500 this year. In fact, when you dive into the numbers, our tactical fund is up 25% this year in US dollars, where the S&P 500 is only up 13%. And that's because we are overweight those inflation hedges like gold, like agriculture, like energy. Now, the worst thing you can possibly have your money in right now in this scenario is cash. In fact, so many people are really going to get hurt by having too much money in the bank or too much money in investments that have really low returns. In the event that you're only making 3 or 4% on your money and inflation is really 5%, it's a guaranteed loser. You are losing money on your accounts. Those need to be invested. In fact, we can get guaranteed interest rates at 5.75%. That is insured. You need to get at least that to keep up. And if you're not getting that, you need to reinvest in things that have those inflation hedges. They can at least keep up with inflation. My name is Matthew Copley, and if you want to learn how we help our clients maximize their income and minimize their taxes, check out the rest of our videos or visit our website.